Joining us now is Guggenheim Partners Executive Chairman Alan Schwartz. Alan, it's always good to talk to you. So you think we're nearing the end of this tightening cycle?
Well, yes, I think we probably are, but I don't think it means that we're going to then turn around and have an easing cycle. So let me give you a little background as to what we believed coming into this period. When we went back to when the Fed began raising rates during what my partner Ann Walsh and then my old friend Ed Yardeni later told me was a rolling recession. I thought that the delevering of consumer balance sheets that had occurred before that cycle started, as well as the change in age demographics that is very significant, would mean that rising interest rates would have less impact on consumption than it had in past cycles, and therefore that economic activity would stay positive longer than many people expected at that time. And so now that has occurred, and as we sit here today, while consumers reduce their exposure to rising interest rates, the financial system took on a tremendous amount of more exposure to that duration risk or rising short-term interest rates, but it takes longer to flow through the system. So the first wave of that, obviously, as my partner Jim Milstein was advising the FDIC on Silicon Valley Bank, First Republic, was the massive wave of exposure that those banks took as lenders, and therefore their marks on their positions in high grade was more than their capital, and that's why the FDIC had to resolve that. Mm-hmm. So that has settled down. The deposit surge out of banks or leaving the banks has settled down. But what we haven't yet seen is, as I say, while consumers reduce their exposure to rising interest rates, the whole financial system dramatically increased that exposure. And we're just beginning to see some of that exposure really hitting a real tightening of credit conditions. And I think, therefore, I just want to say that we still think, while we thought it would take longer to see a recession, we still think there's a recession on the horizon, probably later this year and maybe in 24. So I think, and oh, by the way, on inflation, there are some positive signs with supply chain and imports, et cetera. So I do think the Fed will pause, I believe, probably after the July meeting. But I think they're going to stay on pause for a while until they see how inflation settles out over a period of time.
So just explain more about what you're expecting for the financial system, because it sounds like you do not think the aftershocks of SVB and tightening have fully played out there.
Yeah, I think it's, yes, the SVB was just one part of it. I do think that people will be paying attention to bank balance sheets, especially regionals, less the SIFIs, and that they all had a lot of exposure. But it's really, the first wave, as I say, was lenders' duration risk. But borrowers took on a tremendous amount of duration risk in the last cycle. I mean, an enormous amount. And so now the question is, as those loans start coming due, whether the borrowers who, now would have to pay much higher rates for the same loans that they're paying off will be able to do that, and what's going to happen to that credit quality. The banks are going to have, less incentive to be lending. And so we're just beginning the tightening of those credit conditions, and it's very hard to predict where it can go until you see what kinds of impediments you run into in the system as it plays out.